It's earnings season, and lately the market has been shaking up quite a bit with some big losers. But one group of securities has been particularly neglected throughout the past couple years, despite showing a lot of promise. In this episode, I'm going to fill you in on what this industry is, why it's undervalued, and which security appears to be providing the best investment opportunity right now. My name is Paul, and so far I've invested $100 per month into Canadian securities for 28 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. And I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. Now, the group of securities that has been generally neglected by investors is REITs, and more specifically, residential real estate investment trusts. This is a graph containing most of Canada's major residential REITs over the past couple of years, and as you can clearly see, they've all declined in price by an average of about 25%. Meanwhile, over the same time period, the broader market has done the exact opposite. Usually, when you see something like this, you'd have to assume that something has gone horribly wrong in the industry. Maybe something like rents or occupancy declining, or maybe increasing debts and the risk of bankruptcy on the rise. But that's not the case here. All of these REITs are experiencing strong occupancy in the mid to high 90% range, and they've all been consistently increasing their rents. On top of that, indebtedness has either stayed roughly the same or decreased. Plus, these REITs are all trading below their tangible net asset values, which means that if you were to sell off all of the assets and then pay off all of the liabilities, you would end up with a total value greater than the current market capitalizations. So you're essentially buying into these REITs and getting an instantaneous value per share that is greater than the price per share that you would pay for it. In addition to that, Canada is expected to continue seeing population growth and continue seeing population concentration within its major cities, where most of these REITs own properties. In addition to that, when it comes to building multi-suite residential buildings, there's a strong not in my backyard mentality held by many of the homeowners in these cities, which means that land within these desirable cities aren't optimally maximizing for the number of people that could potentially live there if there were more multi-suite residential buildings. This constrains the supply despite the increasing demand for city living, which acts as a strong upwards propellant for desirable city properties, especially those with multi-suite residential units already built on them. Now, everyone and the Canadian government is already well aware of the housing crisis in Canada, so the government has drafted up a plan to combat this by funding the apartment construction loan program with billions of dollars, and the program is projected to help build 131,000 new apartment units by 2032. The big problem is that between now and 2032, Canada's population is expected to grow by nearly 4 million people. So without substantially more funding, this issue is likely to be further exacerbated, which is pretty bad for people looking to rent or buy in Canadian cities. However, it does present some really strong long-term reward potential for prospective REIT investors who are getting shares at very discounted rates today. The question is, why are these REITs so discounted? Well, I think it's because REITs are often seen as nothing more than a stable source of distribution income for investors. After all, REITs do pay out the vast majority of their earnings to shareholders, which tends to mean less money going to reinvestment and growth. So, with guaranteed government treasury bills yielding in most cases more than the REITs, REITs just appear less attractive to their usual target investors. Now, personally, I think that this wide-scale avoidance of residential real estate investment trusts on the basis of yield comparison is allowing for a great opportunity to buy up high-quality real estate at heavily discounted prices. See, you're probably already well aware that interest rates on treasury bonds are pegged to the rate of inflation, and that the goal of the federal government is to achieve a stable long-run inflation rate in the ballpark of 2%. This would mean that the likely real neutral interest rate would be somewhere between 0.5 and 1%. So nominally, it would be just slightly higher than the rate of inflation. So if the government's inflation reduction measures do end up working, and the inflation rate is reduced from the current 2.9% down to the ideal 2%, we could expect Treasury bonds to be yielding somewhere between 2.5% and 3%, which is a reduction of between 18.5% and 32% from current yields. Needless to say, this would likely draw a lot more investment interest back into REITs, since their yields would be looking much more comparatively attractive. And this is positing a scenario wherein the government doesn't overshoot their mark and require even further reductions to the interest rates in order to try and re-stimulate consumer spending back to ideal levels. So there are a few different ways that the beaten down REITs could benefit strongly in the future, and the downside is relatively minimal. And that's something that appears to track across almost all of Canadian residential REITs trading on the TSX. But one REIT in particular stands out as being in the best position to rise rapidly because its real estate portfolio, management strategy, and price tag make it uniquely discounted, in my opinion. The REIT that I'm alluding to is the Morguard North American Residential REIT, and all of the slides that I'll be presenting from here on are from the REIT's recently reported first quarter earnings. Taking a look at the trust's real estate portfolio, investors get access to over 13,000 rental units across a diverse geography spanning North America, with a high concentration in cities and major urban areas like the Greater Toronto Area, Chicago, and multiple major and fast-growing cities within Florida. This solid real estate portfolio has led to continued rent growth and strong occupancy. But that's not really anything special, since all of the other residential REITs have also seen consistent rent increases and high occupancy. Unlike the other REITs, however, Morguard's management has been incredibly intentional in acquiring newer buildings in prime locations that are relatively discounted, while dispersing of older properties that command a premium. This has kept the average construction age of MRG's properties below that of other REITs, which should increase the long-term ability to collect rents and minimize the need to commit additional capital to renovations and repairs, theoretically translating into more profits for shareholders. In addition to that, Morguard's management is the only one among residential REITs that is actively repurchasing shares on a quarterly basis, and they're one of only two that have repurchased shares at all in the last 4 quarters. So, while the share prices of all the REITs are generally depressed, Morguard's management is the only one that has been taking advantage of this opportunity to buy back shares, thus reducing the outstanding share count and concentrating investors' ownership. This is a really big deal, considering that the trust is priced at less than 1/3 of its tangible net asset value. That means that every time a share is repurchased, investors are getting underlying ownership value of the real estate worth 3 times the price that they're paying per share. Plus, each share repurchased equates to 1 less dividend that needs to be paid out, which means that in the future, even more money can be utilized for additional property investments, repurchases, or dividend hikes, all of which are things that the management has recently talked about. Most recently, in the conference call that just happened, the REIT discussed that they're going to be refinancing, and that the management will be looking to allocate this new liquidity towards property investments, and hinted at increasing share buybacks. Also, a couple of quarters back, when the REIT raised their dividend for the first time in years, the management seemed interested in getting back to consistent annual hikes. Now, despite all of the numbers growing and the relatively strong outlook that the REIT had, the share price once again decreased after Morguard released its earnings. Since last month, share prices have declined 4.38% to just under $15. So it really does just keep getting cheaper. But this isn't exactly a bad thing, since for investors like myself, it's just giving us more time to continue to build up our positions. As for the monthly portfolio's other holdings, next we had MTY Food Group, whose shares also declined by about 2.66%, going from $48.94 at the start of the month down to $47.64. Last month, MTY did release some underwhelming mixed earnings that were taken pretty negatively by investors, but I'm not going to go through that here since I already have a full video dedicated to that topic, which you can watch here if you're interested. The short and sweet of it was that there were some one-time pressures that caused a miss on EPS and revenues. Though the company's free cash flow still came in quite strong, and based on the current price to free cash flow, the business looks quite cheap, even if we only get stagnant free cash flow growth in the coming years. Last up is the one position in the portfolio that's holding things together. And honestly, that's even probably a bit of an understatement since the company is up over 93% from where I bought shares last year. And that company is, of course, Goeasy. And this month it increased in price from $159 per share to well over $181 per share for a gain of over 14% in 1 month. And this is probably because Goeasy is going to be releasing earnings in the next few days, and every time they seem to release earnings, it is blockbuster numbers. So it's not really surprising that there are some baked in expectations and that those are starting to materialize in share price. Unfortunately, despite Goeasy's strong 1 month performance, it is a smaller position within the portfolio, and its upward move wasn't quite enough to push the portfolio back into the positive. In fact, the negative results from the other 2 holdings did push the portfolio in the opposite direction, and I'm now down roughly $162 or 5.85% on the $2,905 that I've invested in the account, which does include the reinvested dividends. Though even if I didn't include those earned dividends into the book value, I'd still be down about $57 on the $2,800 that I've personally put into the account. Taking a look at my portfolio versus the benchmarks, you can see that April wasn't exactly a great month for any of the tracked ETFs, which all ticked downwards. That said, they are all significantly outperforming my portfolio, with the S&P 500 ETF VFV still holding first place, followed closely behind by the Global Value ETF with the ticker VVL. As for the red line with the stars, that represents a 12% annualized rate of return, which is why it's always trending upwards exponentially. My portfolio is of course the green line at the bottom, which is once again quite a ways away from catching back up to the goal, currently requiring an increase of 16.3%. But how things start is a lot less important than how they end, and as much as I sound like a broken record repeating the same thing every month, I do believe it to be the case that the securities I'm investing in are heavily undervalued and that they will provide strong returns over the long run. This means that the portfolio could take several more years before it gets going, but in the meantime, I need to continue trusting the work that I've put into researching, which tells me that these are the cheapest Canadian securities that are within my circle of competence to understand. And just because they're cheap now doesn't mean that they always will be. So I'm going to take advantage of the low prices and get to investing while I still can. Okay, I just received the email confirming that I've successfully purchased 5 shares of the Morguard North American Residential REIT for $15.16 each, and 0.6932 shares of MTY Food Group at a cost basis of $48.41 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, May the 3rd, the portfolio has 130 shares of the Morguard North American Residential REIT worth roughly $1,984, about 12.6 shares of MTY Food Group worth nearly $606, and the same 1.62 shares of Goeasy, which are now worth about $295. Taking a look at the dividend tracking chart, in April, the portfolio earned a total of $9.36, of which $7.46 came from Morguard's monthly distribution and $1.90 came from Goeasy's quarterly dividend payout. This puts our cumulative dividend income for 2024 so far at $34.31, which is already more than half of the dividends that were earned in the entirety of fiscal 2023. And we're now more than a quarter of the way to hitting our goal of $130 in earned dividends for the entirety of 2024, which is great news considering that the larger payouts will be coming in the back half of the year as they accumulate more shares that pay even more dividends, contributing to a virtuous cycle that will hopefully spin off immense returns in the future. While we're on the topic of big returns, May is set to provide the portfolio with the largest amount of dividend income to date, pushing beyond the $10 mark for the first time to hit $11.03, coming from Morguard and MTY's dividends. This is an awesome milestone to finally be hitting, after 2.5 years, nearly 2.5 years, of investing within the portfolio. As for what can be bought with this month's dividend income, well, prices have been going up lately, but $9.36 is more than enough to pay for a 1-month subscription to Netflix's standard plan with advertisements, as well as some chips or popcorn to snack on while you watch. I know that this advertisement model is kind of obnoxious, but the value of getting a full month worth of entertainment for only $6 is probably our hypothetical Canadian's best bet. For now anyways. But a membership upgrade could be looming in the near future, assuming Netflix doesn't pump up the price. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash over the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $117.86, which is nearly a 4% increase from what was expected last month. And the full portfolio's yield on contributed capital has now increased 1 basis point to 4.06%. And that is going to conclude this episode, so thank you all for watching. But before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities, so again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others, and in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.